Good afternoon, everyone. Thank you for joining us, and welcome to Real Talk Office Hours for this Wednesday, May 6th. Quickly, introduction to Startup Grind, who's presenting this podcast. It is the world's largest startup community with 600 chapters in over 125 countries. We have a mission to educate, inspire, and connect, and we do this through three values of making friends, not contacts, help others before you help yourself, and give before you take. Now, it was in that light that George came to me and asked if I thought it'd be valuable and be interested in hosting an update on global markets and an expert roundtable where entrepreneurs and leaders could come and ask for actionable advice. Fact is that the majority of entrepreneurs today didn't have to lead through the Great Recession. They weren't even CEOs during the dot-com bubble, and they didn't have to even study the crash in the 80s. How are they to be expected to do anything but follow their guts or reactionary examples of their peers? In a world of alternative facts and fake news, we need to be informed, rational, analytical, and rigorous in our thinking. The pandemic has been and will continue to be the great global leveler. Now, we invite you to join us every Monday, Wednesday, and Friday live at 1 p.m. Eastern Time as we track the intersection of facts, bias, and action through the analysis of global markets, followed by actionable advice given to entrepreneurs desperate for advice as they do their very best for their businesses, teams, and families. If you miss the live events, you can view the recordings at startupgrind.com/grand-rapids, where you can also download the notes from the presentation, as well as you can find us at YouTube, Spotify, and wherever you find your favorite podcasts. Now, before I pass this on to George, introduce you to him, a little bit of housekeeping. Comments made and views expressed by all participants in this podcast are not intended to invite or incite individuals, entrepreneurs, or investors to buy or sell financial assets, real assets, commodities, futures, and/or options. The purpose of this podcast is to educate and to inform, not to trade or to invest. If you feel compelled to trade or invest, please call your broker. And with that, I'd like to introduce everyone to George Katsanos, our presenter.
Thank you, Corey. Hello, everyone, and welcome to today's Real Talk with Experts. Let's start with public financial markets. In case you haven't noticed, we have gone through mayhem over the last 5 months, and yet the markets, at least the publicly traded markets, are annual between 10 to 15% maximum below the February highs. So, what is this about? Well, let's just start with currencies. Today, the dollar has strengthened a little bit against most of the major currency pairs. You can see that the euro is weaker by 0.3%. The yen is somewhat stronger by 0.5%. Sterling has declined. The Australian dollar has declined against the dollar, and the US is stronger, as you can see, across the board. When we move over to the stocks, the equity market has had, for the most part, a fairly mixed reaction. Japan, unfortunately, was down almost 3% today. The Nikkei was 2.8% down. Whereas Hang Seng, the Hong Kong stock market, was up 1%. China was 0.6%, and generally the rest of Asia, because of overweight China in this index, was up about 0.7%. Europe closed about an hour ago, and with the exception of the UK, where we had an anemic 0.07%, almost unchanged, the rest of Europe was down by more than 1%. A bit more than 1%. Today, here in our markets, the Dow is down essentially 26 points, basically flat. The S&P is flat. Nasdaq, on the other hand, is down about 1%. When we look at commodities, West Texas Intermediate is trading at $23 a barrel. Tremendous difference compared to the beginning of May or the end of April, if you remember, when we saw a low of $10 a barrel. That is $13, more than double. These are incredible changes, huge volatility. The reason for this volatility on oil is one, investors are expecting that economic growth will resume. Investors are expecting that Chinese growth will resume, and therefore demand for oil will increase. On the other hand, as we here in the US are experiencing a gradual opening up, a gradual integration of the previously closed parts of the economy into an open, functioning economy, investors are expecting that demand for oil will slowly increase. Natural gas is just a shade under $2 per thousand BTUs. Um, when we look at metals, I want to caution you about gold. Gold has sold off by about 1.3% today. And the reason for that is temporarily reduced fears about inflation and or economic collapse. We have always mentioned that gold is a safe haven. In other words, investors invest in gold at times either of uncertainty or at times of expected inflationary pressures. When we look at other precious metals, I mentioned also previously that copper is the metal to watch. Copper is an industrial metal. Once we see consistent growth in the price of copper, then we know that world industrial demand is slowly picking up. As you can see from our chart here, the price of copper is today up 0.6%. UBS Wealth Management, a very large Swiss asset management company, is recommended to American investors, please invest in riskier assets. In other words, they are concerned, they say, that most Americans have increased their dollar holdings and they have invested in cash. The UBS wealth recommendations are summarized here. Go into credit, don't stay in cash. Getting off the sidelines, average your strategy, invest in cyclicals, stable and defensive stocks, and go into e-commerce stocks, fintech, automation, robotics, and genetic therapies. In other words, do away with your hard saved dollars, throw caution to the wind, and buy anything that floats. Well, this is not what any sensible person would recommend. As we have always said in this presentation, the reason we talk about financial markets is because we believe that all entrepreneurs should have an understanding of the signals that the financial markets are showing us. That's the first thing. The second is that our entrepreneurs should always pay attention to fear and greed. And this should be a little bit contrarian. So when big asset managers are recommending that you go into risky investments, we have nothing to say except hold on to your lederhosen. It's going to get bumpy again. Very quickly, we have mentioned in the past, and we'll repeat today, that bonds, especially government bonds, are considered to be safe investments and relatively safer than equities. And this is why many conservative investors buy bonds. When we look at the 10-year bonds, we see again Asia Pacific, small changes, very small changes. The only big change was in New Zealand, where we have a reduction in the 10-year bond yield from almost 0.9% to 0.8%. In terms of the remaining of the markets, the Europeans have again remained fairly stable, with the exception of Italy, which was just a little bit more than 0.1% higher. But the reason, as we have discussed, that bonds remain relatively unchanged is because long-term investors have not changed the views. Irrespective of the ups and downs on the equity markets, and especially the recovery from the lows in mid-March, investors, conservative investors, remain conservative. They would rather invest in 10-year treasuries and in the respective countries, bonds like in Europe and so on and so forth, rather than invest in riskier assets. Here in the United States, the yield of the 10-year bond is 0.7%, probably about 15 basis points from the low of 0.55 that we saw that a couple of days ago at the end of last week. Canada is at 0.62% and Mexico is 6.3%. So not much of a change there. This is the snapshot of the financial markets. However, what I would like to focus on is the particular issue regarding Europe. In Europe, we have a major problem, namely the relative disparities in the effects of the coronavirus are beginning to stress the Union. It is clear that Southern European states, including Spain, Portugal, Italy, and Greece, have suffered disproportionately more from the effects of the coronavirus on their economies, at least in comparison with the Northern European relatives, Germany, Amsterdam in Holland, the Netherlands, Denmark, and so on and so forth. We should expect, as the European Union mentioned today, that the collapse in GDP growth is going to be substantial in 2020. It is estimated preliminarily at about 7.5%. And as the European Central Bank mentioned, this is the highest reduction in gross domestic product since the Great Depression of 1929 for Europe. These are significant changes. And as we have warned, together with other analysts of the economy and observers of the world economy, we have to be very careful about our optimism. Thank you, Corey. Please, let's proceed. Any questions?
Yeah, I think on that point of tempering optimism, I saw that Disney's planning to open one of their parks. Is it Asia? Like early this month?
Well, yes. And let me mention to you that Ford lost $2 billion in the previous quarter. Chrysler just shy of $2 billion, and General Motors made a profit of $300 million this last quarter. If you look at your screen, I have the economic section of Bloomberg. The first news report is layoffs start turning from temporary to permanent across America. I think, Corey, that we should keep an eye on what is happening in the Southern Hemisphere. As you know from your geography lessons not so long ago, because you're such a young man, you may recall that we are in the fall season in the Southern Hemisphere. By June, it will be winter in South Africa and so on and so forth, and much of Brazil, Argentina, and Chile, and so on. Let's see what happens to the coronavirus in these countries, because this will be a good prelude, if you want, to our own winter 6 months from now. As we have always mentioned, yes, there is a wonderful effort by Disney, by some of the airlines, by whoever to recover, to reoperate, restart the business. But as we know from discussions with entrepreneurs we've had over the last 8 weeks, no one knows what the next normal is going to be. As McKinsey is saying, McKinsey, the consultants, it is not going to be a new normal. It's going to be a next normal. And after that, it will be another next normal. The reason is this pandemic crisis has created unprecedented dislocation in products, in people, and in processes. Historically, most American CEOs in many crises have always made an effort to give some form of guidance. Last time I noticed 85% of American CEOs of publicly quoted companies, not 1%, not 2%, not 10%, 85% refuse to give forward guidance. Both sides of the balance sheet, both assets and liabilities, have been affected by this crisis. So I think we need to keep a cool head. We need to be a little bit contrarian and to keep on looking into the public news about nuggets of information.
Mm-hmm. I've started to get some calls from some people asking about the reopening of their businesses. Some of them are doing it because they're patriotic. Some of them are doing it because they just simply cannot sit on their hands anymore if they are to continue to operate their businesses. And there's some discussion that I'm seeing about some stresses on supply chains. So what I've been talking with people about is is altering as much of their business to shorten that supply chain as much as possible and focus on their local economies and local customers, especially the small businesses that already serve just people within an arm's length. Would you be able to expound upon that?
Let me start by introducing the omnivore's dilemma. A very erudite academic started looking into food, into the chain from our dinner table to the farm. And what he noticed is that with the advent of low energy prices, with the advent of single crop agriculture, especially corn, soya, and wheat, we have come to a situation whereby the supply chain stretched from the first quarter of the 20th century, all the way to today, to miles and miles and miles, to multimodal transportation, to refrigeration transportation, and so on and so forth. So when you walk into the average supermarket today, you find products from all parts of the United States and occasionally imported.
Mm-hmm.
We anticipate that when it comes to perishables, but also when it comes to certain manufacturing items, we're going to see shorter supply chains and a resurgent reindustrialization here in the United States. It's because of the coronavirus, but also because of other environmental considerations and or challenges that importers will face. It is likely that the focus on specialization that we've seen over the last 20 years or so in the global economy, and with it, deglobalization, are going to some extent to be abating. They will not be lost entirely because there were some valid economic reasons why companies and countries specialized in specific aspects of production. But it is very fair to say that we will see the supply chain will be shortened. We'll see more localized production, more localized consumption. And with that, we need also to emphasize the impact of this economic crisis on incomes. Since the American economy is a consumer based economy. You can, of course, evaluate the first level effect of a reduction in employment. Incomes get become shorter, smaller, they become uncertain. So people's reaction is to tighten the belt, to be more frugal, to spend less. And instead of going into exotic products, they buy locally. We know that our local farms here in West Michigan are perfectly capable of producing the products that most families consume. I will not be surprised if the Saturday or Sunday market becomes in vogue again, with virus-related protection, of course. For more sophisticated products, I think the supply chain would take longer time to mend itself, but we should be seeing more such effects. As I mentioned before, products, people, skills, and processes have been affected by this crisis. These effects are not going to disappear overnight.
Yeah, so when we pay attention to what the consumer is going to look like in 6 months, 12 months, 18 months, perhaps these consumers that are a little more belt tightened, they'll likely be, maybe American consumer is going to be in a better position moving forward. Some more savings in the bank, maybe?
Well, let me amplify this observation by asking you to think for a moment on the average Italian family that lives in the southern part of Italy, or a family in Greece, or a family in Portugal or in Spain, where the social network, the social support network has been fairly weakened already by the 2008-2009 crisis. What do you think the chances are that these companies working in these countries, living in these countries, employing people in these countries are going to continue importing Louis Vuitton or Mulberry or Levi's jeans or high heel shoes from, I don't know, whatever? I think there is going to be a global belt tightening that will have various repercussions. Unfortunately, we may not have yet a crystal ball, and we may never have one because of the nature of economic dislocation and recovery. But what is absolutely clear is that there's going to be second and third level effects. And my fear is that things are going to get much worse before they get better.
Right. Well, I think we would be able to keep on going, and I know that we're going to have another conversation on Friday at 1 p.m. Eastern. So maybe I'll save the rest of my questions until then for you. With that, do you have any last words for our audience?
I would very much like to show again where we are in terms of the markets. If you actually look at how the financial markets have behaved over the last, let's say, 5 years, can you see a chart in front of you?
Yes.
This is the S&P 500. Back on the 12th of February of 2016, we were at about 1800. That was where the index was. On the 14th of February of 2019, exactly 3 years later, the market was at 3,400 almost. A month later, on the 20th of March, the market stood at 2,300, and now we are at about 2,900. I think that the story will unfold in real time in front of us, and the best thing to do is we keep on our notes, we catalog developments, and we try to help by thinking positively and by looking for opportunities and silver linings under every cloud. And I would like to close with this observation that there will always be opportunities. It is only a matter of focusing on the positive side of these dislocations. And at the same time, we should extend a helping hand to those whom we can help. I would like to thank our participants, and I would like to thank you, Corey, for today's presentation.
Thanks.